Hey everyone, hope you are well. Welcome to another edition of Super Prime UK with your MJ Group Super Prime Valuation Specialist, myself, Rob Cohen.
And myself, James Wild.
Hope you're all well. The country has been in mourning. What a spectacular, incredible, respectful send-off the nation gave to the Queen Elizabeth II last weekend. Very emotional, and also, I suppose, something to be proud of, something that makes Great Britain great. And anyone that was at Buckingham Palace or in any of the grounds or the parks in London where the tributes were taking place would have been blown away by that sense of unity and respect. It was really mind-blowing. Moving on from that, maybe one of the biggest weeks of the year so far, with another interest rate change and the mini budget that we're reporting live to you as it's come through, and all of the latest data and intel on the back of schools going back. Summer season is long gone. The weather is turning. Is the situation with the economy or inflation turning, or have the government and their new announcements put forward enough ammunition to get that turning in the short to medium term? We're going to find out or discuss those points with James as he gives us everything that's been happening.
Yeah, thank you, Rob. So let's go straight into the data this week. Obviously, shorter week last week after the Queen's funeral there. So the stats this week, we weren't quite sure on how the data was going to be presented to us, Rob. But in actual fact, we've got very good new instructions this week, 411, Rob, which I think you've correctly analysed. It ties in very well with a lot of the schools returning, whereby a typical sort of uptick in the market at this time of year, going into the autumn months. So yeah, 411 there on the new instructions. Under offers, fairly strong, Rob, again, 182. And sold figures are 118. So we're about sort of just below average on those sold figures, Rob. But like we said, it was a shorter week last week, which I imagine would have some impact there. A lot of, obviously, most businesses only open 4 days. A lot of mourning throughout the country in the 10, 11 days prior to that. So I think there's a lot of sort of rationale which sits behind that, Rob. But let's move straight into the mini budget now, which was announced, and the policies, the initiatives, some of the sort of amendments in the economic and fiscal policies, Rob, they've been far from mini by name, with some real significant changes there. The mini budget, it set out more of a growth plan for the economy for the next sort of 12 to 24 months. Some really sort of strong policies there. So just to give some headline stats on what the changes are. So we've got the basic rate of income tax down to 19%, down from 20%, 20 pence in the pound there. That is kicking in from April 2023. So that's going to mean that 31 million people in the country are going to be better off by around £170 per year. So some extra disposable income for some people there amongst the cost of living crisis. So that will be welcome there, whilst at the other end of the spectrum we've got the 45% higher rate of income tax has been abolished there. It was already announced that April's national insurance rise was going to be reversed from the 6th of November, which was sort of saving money for businesses and around sort of 28 million workers there. So just creating some tax cuts there, again trying to assist businesses and individuals in terms of their sort of take-home and disposable income, which they'll have available to them. The planned duty rises on beer, cider and spirits has been cancelled, Rob, so we've got a hold on the prices there, sort of quite typical for £6-7 for a pint of beer now in the pub. A far cry from when I first came to London. A big one on property as well, stamp duty, Rob. That is being cut from today, as we are here on Friday, the 23rd of September. Nothing will be paid on the first £250,000 of purchases of a property's value. This is double the current threshold, which used to kick in at £125,000. So that is a saving, Rob, for the whole market. There, so that it's a fairly nominal saving, sort of a couple of £1,000 or so, but that will help those which are looking to get on the property ladder, and also those which are just moving up the ladder as well. The stamp duty land tax SDLT, the threshold for first-time buyers, Rob, this is a real big one here. This is increased from 300,000 to 425,000, where that threshold kicks in. So rather big savings there for first-time buyers. There's also, on the value of property which they're buying, the previous initiative was limited at 500,000. So if they bought a property above 500,000, they didn't get the saving. This has now gone up to £625,000. So anything below that figure, that purchase price, you will get those stamp duty savings on as a first-time buyer. So that's really going to help to kickstart things. That'll be helping a lot of first-time buyers looking to enter the market in the coming months and year.
I think those changes could be key to having a positive movement in the economy. The property market really works bottom up, and allowing and pushing or giving incentives and opportunities to the first-time buyers and the entrants at the lower points of the market across the country can then allow that to drip feed up to all the other property bandings. And so I think it's a calculated move that has the potential and the possibility to work as a really good incentive, and we just have to see if there's enough confidence in the wider economy brought about by the changes that have been implemented to give people the belief that it's the right move for them, and hopefully there'll be a positive knock-on effect of that. And as the weeks and months go by in the remainder of 2022, we'll report to you on those specific areas and see what the percentage change has been.
That's it, and that's where the real volume of the transactions is, more in that sort of £250,000 sort of price point. Speaking of first-time buyers, Rob, Help to Buy, that scheme is obviously due to come to a close 31st of March 2023, and it closes very soon for new applications on the 31st of October, so a little over a month away there. The government hasn't announced at this time that they're going to be extending the Help to Buy scheme, so we can only assume it's going to be sort of phased out, Rob, there. So we have to wait and see what impact that has on the property market. What's your take on that, Rob?
I definitely think that maybe they're holding back an announcement on that one. Maybe they're undecided yet on whether it's going to get phased out or not. And then, maybe 95% mortgages with government support and so on could be something that replaces this. I just think they want to see what happens with the market and the economy before making an announcement. I think that's just going to hang there until we know more and have more information.
Yeah, I guess there's sort of more certainty for those buyers if they do opt for a 95% mortgage. As under the Help to Buy scheme previously, the government obviously owned a proportion of your house, and if your property price changed, you would then have to pay the uplift on the proportion of the government's share in the property. So a slightly different structuring there we're seeing with those emergence of the 95% mortgages, which have been out around sort of 9 to 12 months now, Rob. The market it could be affected by this, with obviously those first-time buyers looking to get onto the ladder, use Help to Buy to purchase a property. Particularly in the new build sector, a lot of first-time buyers do opt for a new build, just a bit more certainty in terms of the property maintenance, the unexpected sort of major works bills there. It comes at a time when the UK is under particular pressure in terms of the volume on house building targets, which we haven't met those, Rob. We're quite far below those, so we're going to have to wait and see if there is a new incentive there to try and boost the sort of acquisitions from first-time buyers and those using the Help to Buy scheme. A further announcement in the mini budget was that the Bank of England, their independence is sacrosanct to the UK government, so we're not going to see any changes there in terms of the decision making. The Bank of England will continue to set the UK base rate and independently manage this to control inflation. So that's more of a statement than any sort of change in the budget there, but obviously there's been a lot of backlash the last 6 months or so with interest rates rising, Rob. So just an underlining of the government's stance there, more so than anything else. The planned rise in corporation tax to 25% next year, this has been cancelled and it will remain at 19% for the time being. So the government's not only looking to help the individuals on the cost of living crisis, but also helping businesses, and it's going to help a lot of smaller businesses, definitely on that particular note. And just to summarise there, Rob, some of the tax costs to the Treasury of this mini budget is going to be in the region of £37 billion for the period of 2023 to 2024 there. So they're really sort of trying to spend their way out of the current stagflation, if you like, sort of a period of traditionally it's a period of recession coupled with high inflation. So we're not officially in recession at this moment in time, but we're trying to sort of spend our way out to try and boost the UK economy.
I think there's a high probability that there will be maybe a technical recession. That could be 2 consecutive quarters of 0.1% deficit in terms of growth. At the same time, I think the government and its policies, where we stand at the moment, it's on a cliff edge, because I think a technical recession is manageable. A full-on recession is really not something that anyone wants or the country would be looking to deal with at this moment in time, even though there's a reasonable probability with current indicators that could be where things are heading. Thus, the government and the mini budget are doing everything they can to fend that off. And the third scenario is going into a deep recession, which is definitely not something that anyone would be looking for. So I think we're on a real cliff edge at the moment, economically speaking, with so many variables out there, with another 0.5 point rise on the interest rates this week, with the new mini budget, with all of the variables of economic activity, currency taking a real hit on the back of all of that as well. So we're coming up to a real crunch moment, to which over the coming weeks and months we're going to get a really good indication of whether any of these policies and whether spending our way out of the position that we find ourselves in is going to be the right approach, or a good enough approach to stop anything worse.
Yeah, thanks, Rob. So it's the biggest tax cut event since 1972, I understand, under Barber's Dash for Growth, Rob. Slightly before sort of my time, really, there. Just finally, on the sort of budget there, we've had a number of strikes, Rob, the last 12 months or so across a number of industries and sectors. And the government will now legislate to require trade unions to put pay offers to a member vote so that strikes can only be called once negotiations are fully broken down. So the sort of first port of call isn't to strike. There's more of a dialogue and more of a process there. So I think that's good. I think it costs the economy an enormous amount, certainly when there's rail strikes, tube strikes, post strikes. I think the teachers and lecturers are looking to strike as well in the education sector. I think all these factors really costs the economy enormously, even if it's a day or two's striking. It's not the status quo. It's not consistency.
I think ultimately, in a perfect world, all we'd be looking for is that all of those industries and professionals in those industries get paid accordingly, thus not to be in the position where strikes have to take place.
Yeah. So moving on to interest rates, which were raised on Thursday. So they've gone up another 0.5%, which is back-to-back 0.5% rises there, and it's the highest interest rate level for 14 years, Rob, that we've seen there. The Bank of England previously expected the economy to grow between July and September, but it now believes, Rob, as you were saying there, it's due to shrink in those months 0.1%. So we'd need another consecutive quarter of negative growth to trigger a technical recession, but the sort of GDP, the UK economy, is slightly contracting as the Bank of England is predicting there. It's the bank's 7th consecutive rate rise there, so the interest rate's now at 2.25% base rates. It takes the borrowing costs their highest since 2008, following the global banking crisis. For the August figures, the inflation actually reduced to 9.9%, down from the 10.1%. However, the Bank of England is predicting that peak inflation is going to come in October at 11%. It's downgraded its predictions of the peak being 13%. So I think that is some positivity there, Rob. And they're also a lot of analysts are saying that the energy price caps could also be around a 5% saving on the UK inflation. So we're going to have to see how that government incentive really reacts with the UK economy. Because obviously a lot of these price rises are completely outside of the control of the UK, particularly with the fuel and commodity prices.
Yeah, I think it's very important that inflation is under control. We need to see change, and change must happen before the end of the year. Consumers need more disposable income. They need to know that they're going to manage to pay their bills and rising costs, and all of these incentives and supports and policies must kick in, and the economy needs to turn on the back of all of this. In relation to the interest rates, they are reaching unsustainable levels. It is believed that there will be another hike, possibly another 0.5 point to come, maybe even a bit more. All of the lenders, all of the banks I've been with over the last few weeks have been discussing this key point, and the reality is that if the market was exposed to the new rates of borrowing and lending, that's the end user, the borrower, the applicant, as of today, or as of the increases that we're still going to see, that wouldn't be affordable, it wouldn't be sustainable, and the lenders and the market and the banks are going to have a challenge to deal with those situations. And we're reaching the point where the consumer is going to face levels of repayment that won't be affordable. That's really what's on the cards here. And so we've got multiple areas of concern all happening at the same time and all interlinked in some way, shape or form, that requires change in either the next quarter or the first quarter of 2023, so that we can reverse many of the positions that we're currently in, because if they don't get reversed, we all know what's heading our way.
That's it, Rob. And obviously the interest rate peak is likely to be next year, possibly, with a lot of people commentating this could reach as much as 4.5% on the base rate. I don't know how long it could be sustainable at that 4.5% peak, which is being predicted. So at that stage, hopefully by Q2 next year, the inflation is starting to dampen and be at a more acceptable level. I think we might still be a way off the target 2.0 on the inflation. But like I said, we'll continue to bring you news on that and reports accordingly.
Brilliant, James. Anything else for this week?
That's it from me.
Great. Brilliant. Thank you so much, James. This Super Prime UK special edition with monetary policy, the mini budget, and all of the data and intel and transactions taking place in the property market as we bring you week in, week out. I hope you're enjoying everything we're providing. I'm getting such great feedback from all the meetings that I've had, and you know who you are, and I really appreciate it. Flattered by the attention and kind words that you've given, and all I can say on behalf of us is thank you for keep watching, thank you for downloading the podcast, thank you for watching on YouTube, and thank you for supporting us. And we will be back next week in this dramatic period, really, in property, real estate, economy, lending and finance, and we'll keep giving you our view and perspective of what we're seeing on a daily basis in the industry that we're working in. So thank you for everything, and we'll see you all next week. Thanks, James.
Thanks, Rob. Thanks very much, everyone.